Let's touch base with Loreen Gilbert, who's CEO of Wealthwise Financial, joining us with her take on the markets. Loreen, we had a rally in Friday's session, but I guess the questions still remain, right, on the turmoil in the bond markets and why the equity markets are not waking up and smelling the coffee.
Right. Well, we have a lot of uncertainty, that's for sure. But one thing I'll say is that when it comes to the Fed, we're probably close to the end of the rate hikes. And that's going to offer quite a bit of stability in the markets once we know that we're there. In the meantime, the markets are trying to sort out the banking situation, making sure that it's not a contagion, making sure that it's not going to be a bigger story. And I think we've seen the rally that we've seen has been some comfort there that this is, while it is hitting the banking sector, it's hitting the regional banks, but the large banks are doing just fine.
And which is why your preferred stocks include Bank of America, JP Morgan, and Morgan Stanley.
Yeah, I think when it comes to taking a more defensive position overall, which I think we need to proceed with caution from where we are right now, it's focusing on preferred stocks of the larger banks, the national banks, not the regionals. I think there's too much uncertainty in the regional banks. There's too much money moving, and that's going to cause some issues, continued issues in the regional banks. So while we haven't heard any new banks, most recently, I have the expectation that we're going to hear of more banks, more regional banks that are being impacted. And so with that, I think to be on the more defensive side, using preferreds that are focused on the large banks is the more cautious way to go. And they still provide a nice yield between 5 and 6%. And that I would focus on that versus being more aggressive with buying yet on the regional banks.
Why wouldn't you choose the likes of Goldman? And do you think that it's lost its mojo in the markets?
Well, I think Goldman is another one that you could look at. But once again, focusing on the larger banks versus more of the regional plays, I think that would be, a more cautious way to go.
I've just got to ask you, Loreen, because I would imagine, you start to look at some of even the recent underlying data. So in terms of mortgage applications dropping off by 39% year on year in March, you look at the office space per square footage absolutely collapsing, now back down to around about 2015 levels. Wouldn't all of these things, and I suppose all of the other overlay when you're talking about, the tightening of credit, mean the banks aren't necessarily the safest? Because if you're parking there for safety, you're not generally, or you're far more exposed to any kind of deterioration in the macro environment than, say, parking somewhere that, potentially could be more resilient. And the first thing that comes to my head is a Walmart, for example.
Right. A consumer staple is always something that you look at when we're talking about going into a recession. And so we are aware of the mindset that it will be difficult to avoid a recession. So with that in mind, I think we have to look at defensive plays. You mentioned consumer staples as well as healthcare. Both of those are a more defensive play. But when we're looking at what opportunities there are in the financials, I'd say there's two things. You could go with the preferreds for that yield and, like I said, the larger national banks. The other is looking in financials for companies that are not at all impacted by what's happened in the banks, but because they're in the same sector, they're also getting the downdraft as far as price depreciation. So with that, there could be some opportunities there, some opportunities in financial, but very select.
Loreen, can I just ask you something? Because, some people are suggesting that everyone's panicking too much. You got Tom Lee over at Front Strat basically suggesting in a note that we've had 2 straight quarters of growth for the equity markets. That means that a new bull market is in play. You've got all of this sideline cash, and the last time we had this much sideline cash, it led to practically a FOMO rally. Do you think that there is the potential that all of the worry and concern is for naught?
Well, Yes and no. I would say, look, year to date, S&P 500's up 7%. That's fantastic. When, a lot of investors were nervous that this was going to be a negative year in the S&P 500. But we said from, December that it would be very unusual to have two back-to-back negative years in the S&P 500. So with that, we went into the year with the expectation that we're going to have a positive year this year in the S&P 500, and certainly we have. Given the fact that we've seen such a rally year to date in the markets, we're looking at now paring back on beta, pulling beta back in. We've been above 1 on beta with some of our positions. Now we're looking to bring it back down and pair off some of those gains and looking for the areas of opportunities in fixed income, because there still is so much opportunity in the fixed income world. So I do think there's something to be said for pairing off some of the gains, adding more in fixed income. But yes, could we have a surprise to the upside? Absolutely. There's some people calling for double-digit returns this year in the markets. I don't know if we'll see that. We were looking at, from the beginning of the year, more of a 10%, right around 10%, a little bit less than 10 on the S&P.
Yeah, the market is so divided because we are still getting calls on 3,200 for the index, given that impending recession. So I think the jury's out on that one. But it's interesting to see, while, all of those pessimistic calls are doing the rounds, the index is now at 4,100, the S&P 500, that is. I don't want to talk about Tesla, Loreen, before we wrap up, and the deliveries that came in. You would call them record deliveries, but the fact is that going forward, do you think competition is, kind of going to be an impediment for the business? And more importantly, what they're trying to do in China and the kind of proximity they're building to the production volumes coming out of China. How do you look at Tesla's China strategy helping them long term?
Yeah. So, look, Tesla has the goal of between 1.8 and 2 million deliveries this year. And the question is, given the number that we just saw, are they going to get there? It is possible to get there, but they still have to ramp up. And what's clear with the deliveries that we're seeing is that the price cuts really helped and demand is up. So we're going to continue to see that. And Tesla certainly has a leg up against any other car manufacturer in the EV space. So whether it's, from the China sales, which, now the Chinese consumers are out and purchasing cars, as well as
Loreen,
US,
apologies, we're going to have to leave it there. We're hitting the break. Thank you so much for your time.